I am.
We appreciate you being here. This is something that we do twice a year. We try to do it in the spring, in the fall. This is strictly for clients. This is not a sales thing for us. We don't try to ask you to bring a friend or anything like that. This is just part of the education that we want to do for our clients. Douglas said when he founded this business that the two things that were important were transparency and education. And so this is part of what we do for our clients, and we're glad you're here. We're very casual. If you want to get up and get a refill during the presentation, I don't think it's going to matter to any of us. Or if you need restrooms, they're right outside this door. Our speaker says he would prefer it to be interactive. So if you have a question, feel free to stop and ask a question during the program, and I'm sure he will stick around a little bit afterwards if you have a specific question about a specific holding like that. Anything anybody needs before we get cranked up? So if not, so I've got a bio for our speaker today, but really before I read the bio, I just want to say, we feel like we are really good at what we do. We do the planning. We help with a lot of that. What Lee and his team do are the asset management. They do a lot more for us. They do compliance. They do all of that. But what Lee is good at and his team is the investment management. And so we are thrilled to, we've been with him for a little over a year now. We made a strategic change to hire them as our RIA. And it's just been great for us. It's been even better for our clients. So Lee Larson is the founder and CEO of Everstar Asset Management. He's a second generation investment manager. Spent a lot of his high school and college years working closely with his father researching investments. Been in the industry for about 18 years. He's held prior positions as a fund manager with Fundamental Global, and he was a senior vice president with Capital Wealth Advisors. He currently serves on the board of directors of Craveworthy Brands and I2 Pure Incorporated. He lives in Mooresville with his wife and two children. He's very active in tennis, where I know that he has an amateur national championship in tennis, and he's also a soccer enthusiast. He holds degrees in geography from the University of Northern Iowa and University of Georgia. So welcome, Lee Larson.
Hey everybody, happy Halloween. I actually am an asset manager. I'm not just dressing up. Just a little bit, Jay touched on the two entities are really one. Everstar and AWS joined together about a year ago. Advanced Wealth Strategies is what all of you are familiar with. That's our brand name for everything we do RIA. The Everstar is really getting probably too semantic and all of you really need to know, but is what's known as a registered investment advisor. That is registered with the regulatory agencies. But all the business is conducted through AWS, the brand we own. We kept the Everstar name because Jay mentioned one of the things that I do is I'm a fund manager. Currently, we have 3 funds, private funds. So those are known as Everstar funds. So hopefully that clears up any questions on what's up there. So as Jay also mentioned, please, let's be interactive. This will be a lot more fun rather than me just droning on some of the topics. Some of you will find massively interesting, others will put you to sleep. So the more we're interactive, I think the more informative and engaging and fun it will be. Let me see if I can start with a clicker. Right. The first test, everyone. Uh-oh. We might need the manual ticker. And Logan's coming to rescue me. Look at this. Are you gonna be the clicker? Yeah. That might hurt your knees after a while. You might want to share it. Now we covered this. A couple things on there. By the way, a lot of familiar faces. We had this back in March, February, late February, early March. So I recognize a lot of the same people. Those of you who knew, welcome. Nice to meet all of you. Northern Iowa, Georgia, those are my colleges. Well, come back, there's some fun on it. I can see your face.
Look at the people.
Arsenal. This is their year. I don't. I think that every year. So big soccer fan. My son plays a lot of competitive soccer. He's on 2 travel teams, 2 being the ones because they only even his age up. So when I'm not working on these sort of things, you can probably guess I'm on a soccer field. I do play a lot of tennis, not so much lately with my son going everywhere he is. It's kind of hurt my tennis game the last few years. Need to get back on that when I can. All right, so I'm going to try this again. He said, yeah. Uh-oh, where'd my clicker go?
No, new batteries.
Thank you. All right, starting off with a recap. There we go. Now it works? That works. Let's go. Okay. Sorry, everybody. So some of these topics we covered last time, some of these are new. But one thing that I really talked to the group that came last time is we move ahead of the game, is the way I like to describe it. But we also move slowly. We don't move radically or drastically. We want to do that. That's what private funds are often for, not normal investment portfolios, right? What we covered a lot last time, we talked a lot about what was known as Magnificent Seven, the 7 largest tech stocks, right, that are part of the S&P 500. Those 7 stocks are now 35% of an index that has 500. So that is how dominant they have become. They've basically taken over. What happens to those 7 stocks will drive what happens to the index, not only recently, the last 10 years, but going forward. We also spent a lot of time talking about NVIDIA, but let me get back into the Mag 7 first. We saw this same chart, but it's worth showing again from the last time. This is going back to 2015. This is a performance chart of these various sectors and how they have performed in the last decade or so. So you can see that these bottom 3 did okay down here, but nothing like what these Magnificent 7 have been able to do recently. So you have a little bit of a concentration worry that we all have to think about. This happens time and time again. One things will come up later. I'm a huge history buff. Always happened since I was a kid. And these things repeat. There's that old adage, right? It may not be the same, but it often rhymes history. So we see these things time and time again. Investment world is the same thing. You see these themes play out over decades. Certain areas lead, then they go back, then they lead again. It's timing these cycles that can really add performance and lower risk. Okay, a little bit different. Now, this is from, all of you probably heard of Bloomberg. Some of you may have even played around with Bloomberg. Bloomberg is the most expensive, super high performance intelligence gathering, report gathering software on the planet. One subscription will cost you $40,000. So, but it is incredible what we can do as an investment team and the resources that we can pull through this for information. One thing that is a lower function of it, but I love doing it, really easy to create charts. So you have a lot of Bloomberg charts you're going to see in this presentation. Similar here to what was shown on the last graph. This is going back to 2015, and I know the colors aren't as easy to see, but let's talk about those 1 through 4. That is BM7 is Magnificent 7. That is, of course, the white one going up through the roof. The other 3 are so low comparative you hardly notice. RTY is a small cap index. SPW is equal weighted S&P 500. If the 500 names were equal weighted, it's down here. That puts 7 stocks of them out of 500. DEA is a world index. So again, everything else, 10 years, not that much. But not much. All the growth in the markets, there, 7 stocks. Okay. Well, must be hard. Okay, this same graphs, same names, year to date. You see the price changes. 44%. Magnificent 7 is leading. Different though from February. Those who may recall, those other 3 in February were all flat or down. Those other 3 were flat or down. And we come back to some of the last set. Well, see, they're all down here. They're actually negative for a while. They were just coming out. They've been putzing around. I know the colors are hard to see, but don't worry about the exact colors. It's more the difference between the 2, right? But what I'm showing here is, look, these other sectors are finally starting to come alive. They're starting to wake up. This peaked. Magnificent 7 peaked right there in summer. It's not really come down hard, but it's leveled off while the others have started to move. this is what I meant about looking ahead of the game. I call this vociferously, and not only in this presentation, but in my writings and my discussions with the advisors. We saw this coming, right? That all those Magnificent Seven needed to do. And by the way, they're great companies. They're fantastic companies. They're world leading. What they're not great at right now is value as in price. There's a difference between a great company and a great price. You want both, right? They're great companies at okay prices. I won't even say they're massively overvalued because they create a lot of value, but they're not great prices. A lot of these other areas have become great prices. So it is natural to expect some rotation over the next 5 years to some of the areas that haven't been doing as well, to move up in a valuation sense. Now, remember, I'm not talking about quality of companies. Those seven will still be some of the 7 best companies in the world, no matter what. This is a valuation. There's a difference. That's where my job comes in.
Sir,
Please.
when you say price, I think stock price.
Correct. Yes. But stock price is also a function of a lot of different things, right? So you divide the stock price by the earnings, by the revenue, there's all kinds of metrics. But yes, the value that we're paying for. Really small. Don't worry about the detail. I'm trying to make a big picture point here. This was in it's a really nice magazine you can get. It's called American Association of Individual Investors. It'll cost you $40. And you get once a month, you get a magazine and you get all these access to all kinds of neat things. Nonprofit organization, really neat for those of you that really enjoy learning about this stuff in depth. But this appeared in the last article. And what this is showing, there's those different colors up there are different types of indexes, same thing you've seen before. Rather than getting all the details, I want you to focus on the dark red. The bottom line, this is a 4-page article. The bottom line conclusion of the article is the S&P throughout history is never really in the middle. It is either leading or it's lagging. And this is showing this out completely, right? Look at the dark red. It's either on the bottom or it's on the top. Now, we already know this from the other graphs. Look at this going back to 2011. Look how much time it's spent on the top. Go look at previous times where it spent that much time on the top. What happened next? Gee, we'll rotate it towards the bottom. So we need to think about these things and we need to be conscious about these things as we're making decisions. Right? Yet again, 35% of the S&P. That's what's going to drive it right there. All right, NVIDIA. Some of you, I won't pick up specific names in this room, but all they wanted to talk to me about in February was NVIDIA. He's laughing because he knows. Now, what did I say about NVIDIA in February? I said, looks very, very toppy, looks very bubbly. Yet again, fantastic, awesome company, changing the way that AI is done, right? Everyone needs to buy NVIDIA chips to make the AI happen, right? Awesome company. Share price, yikes. I also said at the time, I have no idea when the bubble stops. You don't. You never know when it stops. But I also showed this graph that compared to Cisco, at one time, those who are old enough, remember Cisco was the be all and end all, and it was going to go to the moon. Guess what? It went down by 99% after 2 years, once it hit its peak. So NVIDIA has not cracked yet. It's actually 40% higher than it was in February when I said, watch out. But what is starting to crack? Some of you that follow this arena in AI, there's another company that was another darling called Super Microcomputer. It was up even more than NVIDIA on the year. Some of you asked me about that one in February, and I said that looks even worse than NVIDIA. Well, guess what's happened to that one? That one's out. Right. And it looks even worse than when I put this presentation together a couple weeks ago. Why? Because their auditors decided to leave, and the stock has crashed 50% since then. The other big bubble-licious type of theme was in the weight loss companies. Eli Lilly has gone through the roof. Eli Lilly's finally started to crack. A lot of the other areas are cracking. NVIDIA is still holding on, but questionable, yet there too, right? Yeah, hey, it is on here. Woo! There's the Cisco graph. And last time, some of you might remember our director of operations, Doug McConaughey, he had a sob story because he used to, was it either work for Cisco or he had a whole bunch of Cisco? And he was sitting there telling us this was exactly him. He thought he was super rich and he could probably retire, but he didn't sell any. And there it was. So we got to listen to his sob story, those of you that were here in February. But I've just been in this field long enough, everyone. I see this time and time and time again. If you have a concentration, and I'm not just talking to NVIDIA, you have a massive concentration to one holding. I don't care how good do you think it is. I don't care how loyal you are to said company if you work there. It's a bad move to be that exposed to one singular investment that could take you from thinking you could retire to not. So that's something to work out with the advisors, right? To have a plan to get that a little bit more balanced. So it's I've just seen it time and time again. 08 is where I most saw it. Those of you around here, Sokovia, a lot of people thought they had their retirements made, gone. Sad. That's a local Charlotte story. Yeah, this is cool. NVIDIA has $3 trillion capitalization. It's larger than the entire Russell 2000 index. It's nuts. It's bigger than most countries' entire market capitalization. That's how big this has gotten. Law of large numbers starts to kick in. Markets are forward-looking. Retail investors and those that don't follow the markets that aren't pros look at the current news. Markets, you heard me say this in February too. Markets look ahead a year. So if now is the best of times, the market's looking what's next year, what's 2 years from now, what's 3 years from now. And if that isn't as good as the best of times right now, it will go down. It's how long does the retail market want to keep it elevated? A lot of the pros have started to sell NVIDIA and some of these Mag 7s. All right, this was a similar chart you've seen. This is NVIDIA, supermicrocomputer, SOX, that's a semiconductor index. This was taken in 1014 before Supermicro really crashed. Here's Supermicro already crashing. Be all the way down to here now. And yet again, this is several people just wanted to be all in that one. Like, no, and they kept telling me I was crazy and I don't know what I'm talking about. Through the summer as it kept going, now they're crying and saying, yeah, should have listened. All right, small caps. I mentioned in February that I thought small caps were attractive. I already talked about this, so I'm going to go on a little bit more. This is a graph that shows relative valuation of small caps versus tech. It is at valuation levels not seen since 2000 in a relative valuation. Now, see how well some people over here in February remember what happened to small caps from 2000 to 2002. We all know tech went like this. Anyone remember? Terry, I know you remember. Y2K? Yeah, what did small caps do after Y2K? Everyone knows the NASDAQ went down by 60% from 2000 to 2002. Anybody have any idea what small caps did? Oh, who am I going to put you on the spot? He's one of our research directors right over there. Who do you know? It did. He's right. It went up 60% up, while the indices and the NASDAQ were getting killed. Small caps flipped. The money came out of those tech in the after the .bomb went into the more undervalued areas. I think history is about to repeat. But the nature of the market has changed quite a bit when it comes to small cap. It's a very different world out there from when I started in the field. Private equity is really, most of these small caps are now staying private. Why? The regulatory expenses and the filings and the workload to be public is onerous, more than it's ever been and increasingly so. So a lot of them are choosing to stay private. So what that's showing is if you go back to 2000, there was 1,900 small cap equivalent size private equity companies. Now there's 11,200. It's more than 10x, right? Quite 10x. But retail investors can't get there. A lot of things that can be read into this, and I'll just walk you through a few of these. The quality of the remaining small caps is key, because what's also happened, as much as I say small caps are undervalued, what's the remaining small caps are there? A lot of them are very poor companies. We talked about good companies at good prices. We want both. They're bad companies at bad prices, part of the index. We just don't want to go in the indexes. For the small cap, we have to be selective. So I said quality remains key. When I'm talking about, I'm going to talk about the garbage side of small caps, and I'm going to talk about the good side. The garbage side, if all you did was go buy the index for the Russell 2000 of small caps, look at that. 30% are expected to lose money in 2024. 20% are barely profitable. 50% of the entire index is barely making money or losing money. It's not good. Even though the valuation, as you see, is much less because of the profitable ones. Before I get more into this, I think this is key. A lot of people don't realize this about the market. The nature of the market has changed so much. Look at that, 60% less, fewer public stock versus the 90s. This has everything to do with buyouts, mergers, bankruptcies, but the biggest key is the top. if you have these small cap companies that used to go through the IPO change, the initial public offerings, staying private, you have less new markets coming, stocks coming to the market. So you have fewer, and there's more and more money chasing fewer and fewer stocks. So you have to be increasingly discerning on what you're picking and what.
That last statement,
Yeah.
just small cap, or that?
That's the whole universe. It's incredible how much it's shrunk. Crazy fun fact there too. There's more ETFs, electronic traded funds, another form of an index, basically. There's more ETFs than there are individual stocks now. It's crazy. It's a different world. Really different world. Yeah.
How many are private now? I guess that percentage has changed, but has the number of private stocks changed significantly as well?
Big time. That goes back to that first bullet point, sir, that it's gone from 1,900 to 11,200 just in the small caps. But then you even have heavy small cap fee, that's your point. Medium cap size, large cap companies are all staying private. They used to go public. Now it's, man, do we really want to? We want to have all these regulations and filing duties and compliance risk. It's a big question for a lot of them. And a big question often was, hey, do we want to go private because we can get better valuations? So but that's another cycle. Private versus public is another cycle and a whole other topic I could talk about. Public sometimes is a better place to be, private is a better place to be. That could revert to the mean and something again also. But thank you. Coming back to this is more simple comparison. RTY against small caps versus the SPY. SPY is the S&P 500. This is from 2020, pre-COVID, just before pre-COVID. 55% up for S&P, 14% for small caps, not quite. But point out again, for small caps, so when we gave our talk, last talk, it was flat. And that entire time, then it went down. Now, notice what I said. It's starting to go up. And this is what I said was going to happen back in February, right? I said, this is coming. I expect that to continue for 5 years. These things do not play out in days, weeks, months. These are years when these cycles take effect. So if small caps are going to outperform, like I keep saying, this is a 5-year play. This is not an out play. Okay. And this is year to date. Further proving what I just said. Look how you go all the way through the summer. Small caps are pretty much flat. Now they're starting to pick up as those S&P has still going up a little bit, but it's starting to get toppled because of the fact. So how do we handle this? One of the things we mentioned is we do have some private funds. We do some private deals there. That's one way we can get access to that. But the big thing that we did as a research team is we went after small caps that are profitable. So that is what we do. We have all kinds of screeners we do when we look at various investments that we're analyzing. And most of the time we're saying no to these investments and we want to find investments. But that is absolute key, is to get these profitable small caps. All right, moving on. Inflation. We talked a little bit about this last time. It's worth talking about again. This is a inflation graph over the last 4 years. Go back to February, I started talking about implications of inflation slowing down. Little history. This is before AWS and Everstar became one. But frankly, I made my name in the asset management business in 2022. Why? I completely got out of all bonds because I believed inflation was about to roar. That was the last thing anyone, it's easy to think about now, but I made that call and actually wrote about it and had presentations on it in 2021 before it happened. When inflation's run like that means bonds cratered. They got beat up just as bad as stocks did in 2022. I not only avoided stocks, I also avoided bonds. In fact, I shorted bonds, the funds that I ran. And it was a fantastic banner year. It frankly made me as an asset manager, if you will, getting those calls right. And come back to February of this year, I told all of you inflation starting to come down, and there's investment implications because of that. Different sectors do better when inflation's going high. Different sectors do better when inflation's going low. It's coming down. Another graph over here. Let me start with the graph before you guys get over here. Similar, but what I like about this is it's forecasting out for 2025. It's got a health index. That's just a healthcare index. It's similar to inflation, right? Look how much it's projected to come down. That's even more than it already has been, right? They're talking about rate cuts. Questions: how many rate cuts? Federal Reserve is going to do. It's hard to say. I've constantly said for weeks, months, that they're too optimistic on how many rate cuts are needed because inflation isn't going down that fast, and that has proven to be the case. Inflation is going down, but not at the speed that the economists and the Federal Reserve think is going to happen. But that's their flat. Our job market's held strong. People keep expecting that to fall off a cliff. It isn't. It's held strong, therefore wage inflation has held strong, therefore inflation hasn't come down as much as everyone thinks it's going to be. But the market is an incredible predictor of a lot of things. It snuffs out events early. What's leading right now? Real estate and utilities. Right? That's a weird combination in an up market. Utilities are normally known as a defensive stock, not an aggressive offensive stock. The utility is actually number one. Why? Rates are coming down. Utilities have a lot of debt. If rates are coming down, their debt becomes a little bit cheaper, therefore they become a little more profitable. So that's where they've done. Real estate's similar, right? Real estate is an interest rate play. If anyone has a mortgage in here, you know that. Anyone that buys investment property, you know that. The lower that the interest rates are, the stronger cash returns you can get, right? You're not paying as much out. And there now, this is one of the things, it's an investment roadmap we use, and we always come back to this. This has a lot on it. I'm not going to get into too much detail, but suffice it to say, the investment team is constantly thinking about where are we on the cycle? Because where are we in an economic cycle, that's what this is showing, those top categories, determines what sectors will do better. Last time I was in here, all the fear that the markets was fear here, retrenchment, we were about to head a recession. I had a little cute arrow saying that we're not. And I said we're here. We were, that was dead on. Where are we now? Here. We are in between early acceleration, late acceleration. In fact, one of the other things we do, we talked about Bloomberg. We have a few institutional research outside service shops that we work with. I emailed the head of research for what's known as Wolf Research, asked him if my viewpoint of where we are at is right. And I will tell you, I was most correct. I thought we were here. Where did you point to? No, I pointed to here. Yeah, I thought we were here. They corrected me and said, no, based on all of our models and our work, we're more here than we are here. But either way, look where we're not there. We're not over by retrenchment, which is a recession, nor are we coming out of a recession. Coming out of a recession is usually the most profitable time to be an investor because things are depressed, asset values went down, you want to be buying here. We're neither, we're on either side of that. We'll get into that tiny event that's happening next week in our country a little bit later, but part of what they talked about is the cycle could be impacted depending which side wins. But the point I'm making before going people too far off when they're thinking going down that route is either way, we're not there. And they made that strong case. So from Wolf's standpoint and our own research standpoint, this is still, the term is risk on. It doesn't mean be aggressive. It just means it's okay to go do your normal investment allocation that you would normally do that your advisors recommend. It's not time to go run streaming based on an election result. Yeah. So that's them saying.
What is defensives in red?
Yeah, great question. What sectors do the best under that specific heading? So if you look at retrenchment, those are the sectors you would expect to do the best during retrenchment. So the color code, I know it's very confusing. There's so much on this graph. So remember I mentioned utilities were leading, and that's weird. Utilities should lead in a downturn, not here. But there's so many factors. I mean, you have the rate cuts, right? And inflation coming down. So that's why utilities are not being where they normally would be. Real estate is. Real estate's usually over here when you're coming out of recession. So that is more accurate. Yeah, thank you. They all line up with a specific sector. So if my head of research tells me, hey, Lee, we and our team think that we are in X cycle, like we thought we were in rebound, and we actually talked about these green sectors in February. If we believe we're in rebound, I'm directing my research team and my analysts to focus on those sectors and investments in those sectors, right? Same thing going forward. So that's one way we keep ahead of the game. And yet again, don't forget, markets work a year in advance. If I think we're here now, I'm not investing for here or here. I'm investing for there. I need to be ahead of the game for all of you and myself. Yeah. Thank you. Yeah, go ahead.
You also made the point, look how to us, that it
doesn't, it's not necessarily linear left to right.
Correct. Thank you, Jim. Yeah,
So you could be moving this way and move back.
yes, because all that talk about, is there a hard landing? Is there a soft landing? Is there a Federal Reserve? Right now, Powell seems to pull off a perfect landing for now. For now, it's amazing. So to Jay's point, you can't, it doesn't have to go like this. You could come to here, then all of a sudden some geopolitical event or who knows what takes you to here. Or 9/11 happens, even though you might have been here, you're suddenly launched over to here. So thank you, Jay. That's a great point. So we have to be constantly aware of these things.
Lee, why are utilities defensive? Why aren't they green or another one? Or why are staple retailing defensive?
This is where I get interactive. It's a great question. Anyone know? Take a guess. Anybody? Really, let's be interactive. Why would utilities outperform during downturn? Yes, sir.
I think it's stuff that people need all the time.
That on right.
Just like,
You can't live without it.
You need lights, you need food, there's certain.
What is the last bill you're not gonna pay? Right? Go ahead, it's coal? You got it on. What was that?
They have good
It's the dividends. I do like the dividends, but the point, the bigger point is, I would say, is the fact that you are not gonna avoid paying your utility bill if you're full. So, and also, what else is a unique feature about the utility sector? Think about a regulatory standpoint. Utility workers in here. Most of them are regulated by the government. They have regulated what they can charge. They have regulated returns they can make. It's the closest thing to a bond that is an equity form. A lot of people call them bond equivalents. So Harry, you brought up the dividend. That's the other reason they're almost like a bond. They're boring. They're not going bankrupt unless you're Enron. And they have good yields. So yeah, good question. Thank you. Thank you. Okay. Moving on. Large cap value versus large cap growth. So I've talked a lot about how I think the S&P 500 is very tech heavy. Those fall into large cap growth. There's a whole bunch of large caps out there that are considered value. Value and growth terms have changed over time. They mean different things to different people, but I'll tell you what it means to most people. Value means more undervalued in the sense of ratios, price to book ratios, higher dividend yields, lower price to sales ratios. Now we're getting the boring analyst stuff, right? That most people don't care about here, and nor should you. That's our job. Large cap growth is more about revenue. That's what growth cares the most about. Are they growing the revenue? They don't care as much about the bottom line, meaning how much are they earning, how much are they growing, because in their view, growth, they can worry about earning money later once they turn off the spigots to grow their companies. Those are the big differences. But large cap growth has absolutely dominated for the last 10 years. But here we go. Why value? Value stocks are, by the way, usually in sectors that are in that retrenchment. Utilities are a classic value stock. Consumer staples, also things that you could not do without. Look how much we all went out to buy as much toilet paper as we could in 2020, right? Consumer staples. Those are value areas. If we start heading towards a recession, those would be where we want to start picking them up. They're also rate sensitive areas. So if rates are coming down because inflation's coming down, also good. But the key is on the third floor. Look at that. The gap is so large between value, we're talking large caps, the biggest of the big, between value, large caps and growth, large caps, that value would need to go up by 100% with growth going nowhere to them to be back to their normal levels. That's how much out of whack it is. Again, these play out in decades, remember? This has gone this way for a decade, increasingly so. If it starts reverting, it'll be a decade of reversion. That's how these things play out. All right, probably the biggest takeaway, but if you guys have any takeaway, not only for yourselves, but any of you that have children or even grandchildren starting to get in the market, this is the biggest thing we can collectively teach them. And I wish we did a better job of this in schools. That'd be, one of my pro bono missions as the company continues scaling it over time. I'd love to start giving some of these talks just to the younger people. It's not education on what they can do with a little bit of money isn't fair enough. This graph's a little bit old. It was 2023, when at the time you could contribute $6,000 a year to your IRAs. I know this is really busy. Don't worry about understanding it all. I'll walk you through it. But what this is saying is you put the $6,000 away a year, like a Roth IRA. So think about your kids, right? If you can put $6,000 away a year, look what that $6,000 a year becomes at, let's do the whole market average of 10% a year. That's the way it's been for the last 80 years, the average about 10% a year. So let's go 20 years out. Your 6,000 a year becomes 378,000. 30 years becomes $1 million. That's $6,000 a year. But the key is compounding, right? Too many of us waited too long to put the money away, right? We might have been putting more away, but we weren't compounding. I asked this question in February, but it's very illustrative. Of all the careers of clients I have, almost every single time, this career has had more investment dollars in the 20s, in the 30s, in the 40s, and the 50s. Sometimes gets overtaken by the 60s, but not through the 20s to the 50s. Anyone remember what that is, or have a good guess what that is?
Versus,
No. Teacher. Oh, no. Poor people don't make enough. We need to pay them more.
Military?
No.
Software engineer?
Yes. And halfway. Revise it.
What's that?
Revise it. You're halfway.
I'm not sure which type.
Engineer.
Engineer.
Engineer it is. Why? Well paid, out of school, without taking a lot of debt to get their degree. And what are they by nature? They're planners. They plan for this. So I can pick on Fu. Our portfolio manager's over there. He's a mechanical engineer by background. So same thing. When I first met Fu, this is an interesting story. So Fu and I, we've known each other for what, 20 years? Long time. When I first met Fu, he just got employed by Caterpillar as a mechanical engineer. And Fu, I want to say that you were eating, I had dinner with you on a cardboard box with a snowboard overturned. Why? It was his mission to put away as much as he possibly could before he got married and he had a spouse to spend on. But it's not just food in the room. I've just seen this time and time again. And you know what's funny? The engineers always ask, "Do I have enough?" They're always the ones that are like, "Do I have enough? Do I have enough? Do I have enough?" I'm like, let me just talk you through all these other professions and where they're at. But it really, the point I'm really hammering home though is if you can just get the young people to really put away back, you got no $6,000 a year back into their 20s, that makes such a profound difference because you got a bigger base once the numbers start picking up, right? So biggest takeaway is that you've seen this chart last time, but this further reinforces my point. This is these different asset classes going all the way back to 1925. If you'd invested $1, this is what it'd be worth now over a century later. At $1 it become 1,000 if you put it in size. All these things we hear about every single year about how we can lose all our money. The day the market still goes up, or left, up or right in the long run. Everything else is little blips along the way if you zoom out in a big blip. Right? So the theme, this little sub theme is time in the market, not timing the market. Absolutely key. And one reason I can frankly say being the asset manager seat, why advisors are so key. Because advisors help clients do things that would be detrimental to themselves, like want to move countries if certain candidates win. You know, that or pull their entire portfolios into gold, right? So that it's just a good point. That big picture, like, hey, think of the big picture all the time. All right, great. One of my favorite topics. This will either intrigue you or might bore you to hear it, but I find it fascinating. One of the things I did in my geography degree was economic geography, and it was pretty wide open. Georgia, of all things, is the top 10 geography program actually in the world. So that's where I did my master's, but the whole focus was economic geography. One of the things that I became intimately familiar with was hegemonic theory, and that really guides a lot of what I do, how I think in this world, in the investment world. So let's get into that, because when I asked the advisors, hey, give me some topics that your clients are asking you want to talk about, and it went back to, I was kind of preluding into this. What if the dollar crashes because of X, Y, Z? Should I go buy all crypto? Should I go buy all gold? Should I get out the markets? What if the brick currencies all gang together and create an alternative to the dollar? Are we going to lose all our money? And am I going to be able to buy and eat and feed my family? So this question for my entire career keeps coming up in different guises all the time. But if you have a big understanding of hegemonic theory, you might be able to impress some of the people you're next to dinner with, and it'll hopefully, one, it'll impress you in some ways, that's what I mean. And the second, it'll calm you for at least the next 2 decades. After that, it might be more worries. Okay, so what's a hegemon? A hegemon is, right now, the US is a perfect example. Most dominant country in the world on a lot of different ways. That is what a hegemon is, right? It's dominant in many, many ways. It's outstanding. Let's go back to, I'm going to talk about who the hegemons have been in the last 500 years. But let's talk on a very, very high level. Historically, the hegemons were naval powers because they controlled trade. You control trade, you control the economy, the economics of the world. So usually there were countries that had powerful navies that could also deploy forces around the world, right? Both military and economically and diplomatically, politically, everything, right? And you could even make arguments, not for here today, religion was tied into this too, as religion expanded throughout the world through the hegemons, right? But the bottom line, the hegemon was the world's reserve currency. The dollar is the current world's currency, right? It's backed by the hegemon. And that currency is enforced by a powerful military. We have that, it bases all over the world, right? We want to enforce the dollar being used around the world. We also have, well, price in dollars. That's a huge part of our geopolitical power. As well means that could change things, but it is what it is right now. Hegemons want to maintain the prevailing economic system for not only their good, but for the good of the world. So you need other people to buy in. You just can't do this by yourself, even if you're the strongest country, right? You need other countries to benefit by the hegemon. So the term in my world, when I was in grad school, is Pax Americana, American peace. Since 1950, we've been the world's peace. And most countries benefited by being part of that, or if they were excluded from it, it hurt them, frankly, on their economic growth. Here's a fun part. This ties right into financial planning. Hegemons last 100 years, 3 generations. Same way that most families, after 3 generations, lose their wealth if they made it. Guess is what? All of you are thinking, I can tell you some of you don't want to say it at the risk of being political. That's where we're at now.
Strong generations make weak generations?
No. I get what you're saying, like you had a World War II generation that were great. Well, let's go through that, John. Thank you for starting. So we had the World War II generation, 3 generations. They came from nothing. They worked their tails off. They won a world war. They came back and they took that attitude to rebuild. Then what? What's generation 2? Boomers, most of you in here. Boomers saw what the parents had to do. Boomers saw how hard the parents worked. Boomers took the work and the wealth and the opportunities created by the greatest generation, World War II generation, and expanded upon it. No different than most families that have a lot of wealth. What happens by the 3rd generation, though?
It's just passed down.
Spoiled. Yes, sadly, spoiled. It's the same thing in family economics. It's the same thing in countries. Welfare becomes gigantic. If you look at welfare spending between the 3 generations, and you can go back to every one of these hegemons I'm about to bring up, it was the same thing happened time and time and time again. Welfare spending starts increasing. Big time. Debt increases. Debt servicing increases. What's happening in the military at the hegemon? When that's happening. Yeah, people are nodding their head. It's getting weak because they don't have the same money. The hegemon starts to weaken. Other countries are buying to be hegemons. Here's the sad part. I said it will depress you. Yeah, world wars. That's how they happen when a hegemonic change happens. Now, we'll see whose history buffs in here. Let's first explain this chart, then I'll get into who's history buff and knows anything about these things. The emerging global leader and the emerging challenger were going into a period of wars and instability around the world. The one on the left, emerging global leader, ended up being the hegemon. The emerging challenger was the closest one, but they did not become hegemon. So it's worth just a few minutes of walking through the history. It'll help you give a real strong context to the U.S. hegemony now. Any history buffs have any clue what happened between 1494 and 1517? I will be incredibly impressed if you do, and no looking up your phones here now. Phones.
I remember at one time out there, going back in history, I thought it was when Portugal and Spain actually each controlled them.
Right around there, yes. I can't remember the name of that treaty, but you're right. So from Brazil on over was Portugal to the west, and to the east of Portugal was Spanish territory. That was part of it. But notice what's up there. All right, no other guesses. You guys got 2 of the major events there, right? So I'm impressed by that. There's known as the Italian Wars. But Italy wasn't a unified country at the time. The dominant powers in Spain were Spain and France at the time. It was basically a world war between Spanish allies and French allies. This is different than the other hegemons because Portugal was not involved in the fighting. They went and focused on their navy and they went and focused on their economy while the rest of the European powers were having at it with each other. And they ended up as a hegemon without being involved. Only one of that situation. All right. Any clue on history here? What happened here? 1579, 1609. Netherlands of all things, another small country, that was a hegemon in the world. Interesting, right? I went to Jakarta 5 years ago. Second most spoken language in Jakarta, Indonesia is Dutch. Dutch control the world as a hegemon, naval power. Any idea what that is? All right, no guesses. Not even a guess. It was a Spanish, I think the right term. Netherlands became independent, or Spanish independence, right? It's known as a few different names. Bottom line, Netherlands became independent of Spain. There was a real, the king died, the Spanish king died, and there was big questions about who was going to be his successor. It wasn't clear. And the European continent went to war. What ended up happening, because at the time, Netherlands was a Spanish territory. At the end of it, Netherlands became independent, formed a very close relationship with England. In fact, had a king that was both William O'Barron was his name. He was king of England and Netherlands. Wow. And they became the world's hegemon. Now, remember, hegemon means they had the strongest navy and they had the strongest economy and they were the world's reserve currency. Now, this one. Notice 9 Years' War in Europe, another huge war between France, Louis XIV, and the rest of Europe had to gang up because France was the strongest country. Europe was only unified, big unified one at the time. So the rest of Europe had to gang up on France. And they ended up beating them back, and Britain became the first time the hegemon. Britain was the only two-time hegemon. There was a gap in between where that so-called spoiled generation could go away. Now, okay, now this is a history. I gotta expect several people know what happened here. What was this? 1792 to 1815. What was 1815? Come on, all of you know it, even if you don't know the exact date. What was that? That's the next one. 1815. So who is it sang that song? I can't think of it. ABBA, right? ABBA sung a song. The name starts with a W. I think it's ABBA. Tell me if I'm wrong. Waterloo. Everybody gangs up on Fort France again. And Fort France loses again. And Britain becomes a global dominant power yet again after that. Now we're coming out of that, Germany started its overseas expansion. They're a little late to the game in terms of being a colonial power. They're trying to rapidly catch up. So that headed into World War I. Now remember, this is saying 1914 and 1945. There were two world wars in there, where United States and USSR were the two coming out of that as the two potential hegemons. We all know most of us know that history now. It's near and dear to our hearts that the United States ended up being the hegemon. But notice the time frame, 100 years, mostly, right? That's why I said I'm both going to make you feel a little better and also depressing. If hegemonic theory is correct, we got to about 2045-ish, right? Before we got to start worrying about this. So are the dollar, but like, look at this, is the dollar going to tank now? No, not unless our military does. Not unless we're not a hegemon. And unfortunately, for the dollar to tank usually means there's a global war to throw us out as the dominant power, right? Okay. So short term, no worries. Longer term, bigger picture. Could be worse. Deficits matter. It's crazy. You go all the way back to Rome, right? Why Rome fell. Bread and gladiator games was the talk. They kept the populace stupid by just feeding the bread and making them go watch gladiators instead of focusing on what's really happening around. The parallels in history are mind-blowing. So this was a big part of my academic studies. I quite enjoyed it, honestly, and really it does shape a lot of how I think about global politics and all of that. Questions on this? Anybody? I know it's kind of deep, but yes, John.
One thing I think we may have missed is in the previous slide is that historically, the naval powers have controlled trade, and moving forward, it says there that technology will, because of
Thank
the
you, John.
times.
Yeah. John's saying this because John over there helped me do this thing. John's operating as my chief of staff as one of his many jobs. But John also has unique experience on this. John was in 2 combat tours, both Afghanistan and Iraq. So John is a combat engineer by trade. So thank you for your service, John.
Thank you for your service.
John. So John was the right, he quickly, when I was going through this, number one, he found it fascinating from the military background. But secondly, he was right. The future hegemon will not be Navy. Navies don't matter the same way they used to. It's who controls the technology. And that's where the war is being fought, is AI spending. And that's why you're looking, we go back in the video. There's all kinds of discussions between the USA and China with tariffs for technology. We're trying to keep the technological edge over each other. China's trying to gain it, we're trying to restrict it. That's going on already. If we had another graph on here, China. Right, that's just coming up. The question is who would China? Now remember how this graph works though. Who would be the emerging power besides China? Because the old one goes away and then it's two new ones by. We don't know that yet. Could be India. India is growing rapidly. My guess. But thank you, John. That's great. Oh, boy. I talked about this in February. I'll talk about it again. Yeah, we are definitely in a very bipolar world in this sense, right? But look, I talked about this in February. I long ago became apolitical. I have to in my field. I have to. I really, really have to. And I was an advisor and still am an advisor, but mainly an asset manager now. At every single election, I have clients that tell me if such and such win, I'm selling everything, the country's going to pot, and I'm moving to Canada. And I have both sides telling me that right now. I had both sides telling me every one of the elections. Every single time after 4 years, what did the market do in the long run? Lower left, upper right. In fact, election years are usually up. What happens in election years is once the winner is known, they start buying the sectors that benefit from that administration, selling the ones that don't. I don't know if I want to depress half the audience because the market is making a very, very strong prediction on who the winner already is. And the market is very wrong. I'll say that, but rather than depressing half the audience, let's just say that it usually ends up. There could be a little bit of turmoil in the markets. There's a little bit of an air pocket today. NASDAQ is going down, the tech stocks are going down, Microsoft had poor earnings. Meta had poor earnings, super microcomputers still blowing up because their auditor is gone, NVIDIA's finally cracked, it was 5% down last time I saw. Why? We got an election on Tuesday. No one's gonna step in and buy the market in the next few days, so it could have a little bit of going down in the next few days. Don't let that freak you out. Everyone's doing what I'm doing. I'm not gonna put any of our money in until I know it's a winner at this close. Why would I? Right? But what I'm telling you is there could be some upheaval in the next couple of weeks after that. But it's mainly rotation of sectors once that happens. I will tell you this. So if the Republicans win, you probably could see the indexes going down because people rotate out of the tech and go into some of the other areas that benefit from the Republicans. That's just short term, right? If the Democrats win, it would be more of a status quo as of what's already working. You'll see the Mag 7 potentially hang on longer. So, but either way, I don't expect a long-term downturn, no matter who the winner is. All right, switching out of that, and I'm purposely avoiding questions. Fun fact, that's performing asset class in 2024. What is it? Gold. Hearing a lot of different things. So show of hands. Oh, you're gonna be brave. Put up your hand. Come on, everyone's got a pick. This is fun. Let's go with A. Who says A? I have gold. Who says gold? I have 3 for gold. 3. S&P 500. Vast majority. Cash. Good answer. Cash. Bonds. Bonds number 2. Barely above cash on. S&P is about 24% up. Gold is about 36. Gold is on. Weird thing. It has its own rhyme. Everyone tries to figure out a rhyme or reason to gold, but it really has its own. But every fear from dollar fears to what if this candidate wins fears is being played out. So takeaways. So those 4 things if you walk away with. I don't know why we have 4 ones again. I made the same thing last year. They're all equally important.
Everyone is important.
S&P 500 concentration, talk about that. Do you have questions, sir?
What companies make up the?
I'll have the audience help. All right, audience.
NVIDIA.
Video.
Yeah.
Number 1. Okay. Keep going, audience. Yeah, Microsoft, Meta, old Facebook, Amazon, Apple.
Tesla.
Yes, it's a new one.
Yeah. What do we call them?
How many we have? 6. It's the last one. People don't think about this one. I don't know why. We all almost use it, almost all of them. What was it?
Oh, Netflix?
Google's one, Netflix the other. 027.
If I put Netflix in there, I got paid.
You got 8? Tesla sometimes is included or not. It usually isn't, but I often do. It's moved up so much. All right, so S&P concentration. Small caps should be the beneficiary if the S&P starts to slow down. Now, remember, I'm not saying S&P is necessarily going to just drop and go down. I'm not saying run away. A lot of us have a lot of holdings in there, and a lot of those holdings have very big capital gains that we would need to manage over time if we wanted to get out of them, not all at once. I'm not saying it's going down hard. All I'm saying is I think it's going to underperform relative to 200. So areas where we can move, we want to overweight those areas that should benefit, right? So I want to make that distinction very, very clear. Dollar demise, I hopefully enlightened or reported some of you with hegemonic theory for quite a while. I could literally talk for an hour. And then lastly, election. Yeah, it'll all be over soon. It's not the best thing I can do. Sure. Question.
So the projection, based on what I'm hearing, are you gonna wait as the small caps more next year? What's the projection for 2025?
Regardless, were you tying up the election or no? I wasn't sure. I think you had it.
Yeah.
A little bit.
I think the election's out.
So, no, I appreciate the question. Remember how it worked too. One thing that I think about. And when AWS and Douglas and Steen were vetting me as potential merger partners, right? One of the things they really were wanting to know is how I think about the markets going forward from a bigger picture standpoint. And one thing that I impressed upon them is when I was mainly an advisor and not so much of an asset manager, I would surprise my clients because they would come to me and say, hey, this and this happened. Should we make moves? My answer always was, and my answer to you is, I already did that. I increased small caps in February. I was early. Okay, my cycle is working years, not months. What did I do in the last quarter? I shelled them again. So to answer your question, it's not what I will do. I've already done. And that's how I operate all of your portfolios. Really. Some things I don't talk about because it's no point getting into that. The advisors are always aware of this. We have a monthly call right in. One of the best moves we made in all of your portfolios this year was we increased bonds throughout the summer. Summer was volatile. So we reduced our exposure to equities. When I talk about this, I'm talking like a macro across all portfolios type of thing. Like I'm just I don't want to go too much into individual portfolios or names, but we did increase bonds. Towards the end of September, we removed all of those overweight and we went back to normal weight on equities. That timing turned out to be really strong. Bonds went up over the summer months and were volatile. And while the markets took that little dip in the summer months, now bonds are starting to go down as the market started to move up. So those are some moves. I'm always thinking this way. I'm always ahead of the game when I make these moves. Other questions? Yes, sir.
You must have had some bad calls though in your life.
Absolutely.
Let's hear about some of that.
No, that-
I just want to know that you're human.
Yeah.
And it's not Halloween, right? So I'm not just playing asset manager. No, it's a good question. And this will be rather amusing because I'm going to let someone roast me here. The person that knows me the best, and we've worked alongside each other as investments for years, that knows all my weaknesses, and that's one of the reason I choose to have this guy so close to me. Dude, you know what's coming. Dude, you tell him. Is this guy, never an economics spec, he's an engineer by trade. His strengths are often the opposite of mine, and vice versa. So if he could better tell you, and go ahead, rip me where you can find it.
Best thing in technology is probably not.
You hear that?
Not really.
You gotta speak up there.
Said,
Stand up.
technology is probably not the area of expertise.
I don't give off a cutting edge appearance. What else can you think of? What were my biggest errors?
Sometimes staying a little bit too long.
Yeah, agreed. Too stubborn. That works both directions.
So I tend to remind them, it's time to sell, it's time to take profits. Stay too long.
Interesting story with Fu. He was trained by the same guy I was, and that's what I thought. So early on, Fu and I recognized this would work in the long run. for us to join our collective talents, right? And while my father was still alive, he passed in 2016, but his first career, some of you that were here last, his first career was with Firestone. He worked abroad in as a plant manager. So I got to grow up in some really interesting third world countries and all kinds of weird things happened in those countries. Hence why I got into geography. But his second career was really at a family office running, because we were expats, we were abroad. He made very good money in those days. That's the golden age of expats back in the 80s. You got paid a whole bunch of money. You got a house, you got a chauffeur, you got a maid, all off first class tickets on the Boeings where I got to go up as a kid in the top level, right? That was my young life. So he made quite a bit of money in those days. But when Bridgestone came and bought out Firestone in the late 80s, they asked him if he wanted to go to Kenya, and he'd already been overseas 30 years. He's like, I'm done. So he retired from Firestone, basically opened up his own family office. And that was me researching as a high school kid and college kid, right? And, who got the benefit from some of his expertise too. So that's why I said it. To answer your question, and I akin this to creating a team. I'm a huge sports fan and love participating in sports, not just watching it. And it's the same thing with business and life and relationships. It's the team you have around you. It's not one person. I have a lot of faults, but one thing I would say I've done very, very well is find people that know those faults and will call me out on those faults. That's not easy. And one thing that I have always had, and this comes back to, you grow up in a Buddhist country for a large part of your life, they have a really neat thing. It's called beginner's mind. And I've always tried to live this. Beginner's mind is you approach every situation as it is new, without any preconceptions. Even if it's something you've known 1,000 times before, you approach it fresh. No judgments. That goes to people, that goes to situation, that goes to economic environment, that goes to any changing news. And as a research team, that's what we do, right? And that makes the losses less. But I go back to another point I make. I don't trade this way anymore, but I do love the question. But back in 2013, Sue and I, on our own, without running anyone else's money but our own, one other guy that was crazy enough to do this with us, decided we were going to trade options. Really speculative stuff. The end result is we were up like 200%, I think. It was something ridiculous. It was something ridiculous. But the point I'm going to make, what do you think our winning percentage was? Wins versus losses?
30.
Yes, 30% was that. That's all we had. We lost 70% of the time, but we were up several 100%. It's not about the losers. It's about cutting the losers short. Right? Don't let the losers ruin you. That is in stocks, that's in life, right? If someone is a drag on you, they're a vampire in some way, cut them before it's too deep, right? The same thing with stocks. You've got to be able to cut. You got to have that discipline. And I would say if food does anything, that's the biggest thing. Dude, time to get out. You told me this is going to work long enough. Get out. You can buy back in. That's like food's favorite foods. Great question. Any others?
Yeah,
Yes,
we
sir.
did our review with Jay and Renee a couple weeks ago. They were telling us about a private fund, I think it's called ESAF.
Yeah.
And I was just curious of what your thoughts were about that.
Sure. So we do, Everstar does run a few private funds, right? This is something that we probably want to talk about more on an individual basis with your advisors. We can do different things in a private fund than you could in a normal portfolio. We have a lot more flexibility, right? We can pick private investments, for example, that would be outside the realm of a normal stock account. And they've had banner years, frankly. They're a very different proposition, though, than what most of you are used to. So, but if that's something you're interested in, I'd say, hey, that's something to bring up to advisors. Does this make sense for them? And there's different strategies, some riskier than others, more volatile than others. But for those of you that have the right, temperament for it, and it's a proper fit for the portfolio, it could make sense. Did that help? I was a little evasive.
That's okay. I'm just curious what your thoughts were.
Yes, sir.
What are the returns? I'm very interested in.
I love the question, but I'm smiling because Perry's already in it, so they've been very, very good. But no, I think that's too. But it's a different dynamic. So remember what funds do. Money in Schwab, for example, is very liquid. You can get it very fast. If you're making an investment to a fund, you're basically saying, I don't need to touch this money for X amount of time. Funds also have higher fees. The higher fees can be justified if the returns make sense over time, and that's okay. But you just have to know that you don't go into a fund in something you're thinking, hey, I'm gonna pull out soon. Because when you manage a fund, when you go into my seat, you need capital that you know is gonna be there, especially if you're making investments into private investments that can't be sold readily, right? You can't have people say, I want to come in this month and I want out that next month. That's just not how funds work. But yeah, thanks for bringing that up, guys. It is something I certainly enjoy doing, like part of my day to day. Oh, yeah, on time. Did I drone on it a long enough?
Yeah, no, you.
What other questions do you have? Yes, sir.
Exposure to China or by hiring levels.
Hmm.
Thought it might be interesting to get your take on
Oh.
China. And they eased funds recently, but they're pretty volatile over there. And
I love the question.
So,
Love the question. Yes. It's one of these no-win topics at times because people have preconceived notions of China, right? China is the cheapest stock market in the planet by a wide margin, not even close. Chinese stock market has gone nowhere, literally nowhere for the 15 years. It's flat. 15 years. The second biggest economy in the world, flat. The stock market is the problem with China. The Chinese treat it like it's a gambling casino. They run it up high, then they all get scared for a generation and don't want to touch it until the next generation gets brave enough to go treat it like a casino. They're not investors by nature, they're traders. But it's one of those. Remember talking about the market looking ahead. The Chinese news is as bad as you can possibly get. It can't get any worse. It looks horrible. The real estate market's blowing up. There's trade wars with USA, on and on and on and on, right? Their accounting can't be trusted. I could lay off every single thing that's wrong with it. But interesting you asked that. If you look at the fund, it's one of the heaviest weights because of the valuation. And that's what we are first and foremost. We're value guys. So yes, we have to consider all the qualitative, but it is that attractive that we're willing to overlook all the litany of potential problems from A to Z and go put our money and other people's money into it because we think the return could be very, very lucrative going forward. So not only am I putting more money in China, I'm putting more money into emerging markets as a whole. Furthermore, I would argue the dollar is about to go down. If I put a chart on the dollar up there, it's been nothing but straight up for the last 10 years. It is very overvalued, the dollar is relative to the rest of the world. I love it when I go on vacation in the summer, but I think that reverses. And the dollar starts reversing. Now you have a currency tailwind on top of valuations. So did that answer? Thank you. Yeah,
Any others?
yes, sir.
Yeah, you seem to like it, Russell. You mentioned the Walker 2000
Yeah.
small cap upside. for
Right.
5+ years. And then you had your graph, and half of them are really
Yeah,
losing money and barely
Right.
doing anything.
Correct.
So you're going into that top half of the Russell 2000, maybe buying those
Correct.
individual stocks? Is there an ETF that looks at the top?
There is an
half?
ETF. There's an ETF, and most of you have that ETF in your portfolio. So it took us a while to find that. Those, now, everyone in the room has different portfolios, right? Some of you have ETF, some of you have individual stocks. If it's individual stocks, we're going after the profitable side. If it's ETFs, we're choosing the ETFs that only focus on the profitable. It's a whole nother topic that could go on for about 10 minutes on, but if you want companies that can grow their dividends too, not just have dividends, that's a function of growth. You're not growing your dividends if you're not growing revenue. So that's another thing they want to look for. But good question. Yeah, hyper aware of that. We don't want the regular Russell for all those reasons.
So Lee said he would stick around a while if there were some further questions. We do want to be respectful of everybody else's time, so we'll end it there. I will say when the China question came up, they've been in the news a lot. David Tepper, who I think is a better stock picker than NFL owner, evidently. He made a lot of big news about 3 weeks ago. He said, I'm buying everything I can in China. And so on our next call, Lee made the point that he said, again, this is what he says all the time. He said, we're already there. We've already been there. Lee is really good at the forward. So thanks for coming. Feel free to get some more food. People, call us if you have any questions.
Okay.
Thank you.
Gonna be a-
Yeah. That bag is- Oh, no.
Okay, I started like, more, but that's because I have.